Alrighty, we will get going here. Like I said, my name's Steve Wildman, Vice President of Planning here at Diversified in our home office. For whom this is not your first webinar, you're probably wondering, who's this guy and where's Andrew? I assure you, Andrew is certainly fine and well. He couldn't be here today, but he'll be back in the first quarter of 2025 to continue the regularly scheduled program. On behalf of myself and all of our advisors here and everyone at Diversified, I want to thank you all for entrusting us in helping you achieve lifelong wealth. Before I hand it over to Mike, we've had a very interesting 2024, to say the least. Continuing conflicts seemingly all across the world. Obviously, everyone knows that there's a election coming up in about a month, which I'm sure if you're like me, you've noticed a lot more commercials on your TV programs. And unfortunately, recently, a hurricane season that's certainly kicked up and hopefully coming to an end soon. But luckily for us, we have Mike Horwath here, Chief Investment Officer at Diversified, to make sense of all this and more. So Mike has a number of slides and comments, call it 20, 25 minutes or so, that he'll walk through. And we also, as always, save about 10, 15 minutes at the end for any questions that you have. To ask a question, you can certainly use the chat function on your Zoom screen. So with that, Mike, I'll hand it over to you.
Awesome. Thanks, Steve. Welcome. Great job in your first one. And speaking of the political communications, the amount of mail I get and have to throw away, I get the same thing like 4 times a day. It's absurd. Either way, as always, welcome everybody. My name is Mike Horwath. For those of you who don't know, I'm the Chief Investment Officer here at Diversified. Give me one sec, guys. Chief Investment Officer here at Diversified. Today, we go through our quarterly investment update, our webinar, where we kind of walk through slide by slide what's going on in markets. Well, I would like to have a theme as well. So for this one, anybody who read my newsletter this morning, just heads up, a little shameless plug for my newsletter. It came out this morning from Sarah and our marketing team. That newsletter is titled The Great Debates. Naturally, with the election coming up, I think there's some key debates happening here in markets and the economy that are really important to walk through and to understand and really understand both sides of it, and the decisions and really the ramifications from those debates of what's going to happen will have kind of this ripple effect through economy and markets. So we'll go through one by one kind of the major debates that we're seeing, what our position would be on any of them and how we think about it. But to what Steve really highlighted at the beginning, it's been kind of a crazy year in many ways. From a lot of stuff going on from a monetary policy perspective, the Fed has been in the news nonstop. Inflation has come down. It has not been as big of a conversation point, although it's still very important to keep an eye on it. But the main focus has been on a combination of what the Fed is going to do and what's happening from an economic perspective. Is the economy going to be pushed into a recession, to this hard landing that you keep hearing about, where they get inflation down, but they push the economy into a recession, or a soft landing where we can get through this inflation conversation, and on the other side of it, we avoid that recessionary environment? We'll talk about all this, but it's been a crazy year from that macroeconomic perspective. And then the geopolitical side of the coin, where you still have Russia, Ukraine out there, which has kind of fallen to the rearview mirror, because now you have tensions in the Middle East that kind of keep escalating. And we've gotten that question a few times over the course of the last couple of months. But when we talk about where we're at today, growth continues to be kind of my primary focus, my primary concern, and really what I would consider the risk of the market. And I think it comes into effect on both really like how the economy is actually doing, but I think it's also sentiment. I think people are waiting on, is the economy going to hang in, or is that risk really truly still out there, that we get pushed into this hard landing where we start to see negative GDP prints, things to be concerned about? We haven't seen that yet. You see it on the right-hand side. That's called the Atlanta GDP Now graphic. They update this pretty much daily, where it's a real-time estimate of GDP growth for the given quarter. So right now they're focused on Q3. This will flip to Q4 after the estimates or the real numbers come out, the first numbers for Q3 GDP. But you see The green line shows GDP growth remains above trend, and we typically look at trend right around 2%, right around trend. We've talked about inflation. Inflation is still above that 2% target, but we are well on our way below 3% on many readings. You saw PCE, which is one of the metrics, CPI, the other metric. Many of these metrics are showing inflation numbers coming down below 3, a little bit above 2. So the Fed, has to keep that under consideration. But, when we're talking about the Fed, they finally pivoted. July 2023 was the last time that they raised rates. They've held rates steady since then. And as of September, they finally pivoted and they cut rates by 50 basis points, 0.5% for the first time, really since kind of peaking back in July of 2023. We believe, the corporate fundamental landscape looks really strong. We'll talk through that here shortly, which kind of ties back to corporate earnings, margins, projected earnings looking into 2025, 2026, all point to a pretty healthy corporate environment across the board. Taking a step back, looking at what's happened in asset classes, I think many of you have seen this on your statements, or you will see it on your Q3 statements. Markets across the board have been really strong. Not only equity markets, I'll point out. Look down below in the fixed income markets where pricing for cuts started to take hold. So not only have you gotten your income yield from fixed income, you've gotten a little bit of price appreciation. And what we've seen is fixed income core bonds, really using the US Ag Index, up about 4.5% through the end of the quarter. But what everybody wants to talk about, global stocks, especially US large cap, up over 20%. But you see global stocks across the board up nearly 19% on the year. A really strong rally, strong bull market behind this, and ties back to some of the things we're talking about with economic conditions being pretty darn strong. As we kind of segue into what are these debates, and I think there's really 3 key ones I wanted to highlight on was, one, it's bull versus bear, right? It's can this bull market continue, or are the bears going to finally be right? And look, the bears are always right eventually, and then it flips, right? But people can be bearish for a long period of time before they are right. And we look at this and say, the bull supporters are focused on earnings. They're focused on kind of this economic condition where you're getting to inflation coming down and economic growth remaining steady. We talked before, economic growth is above trend, above that 2% mark. So you have strong earnings, you have still strong GDP growth, and then inflation, while inflation is probably one of the key risks, it looks like it's not that key risk anymore, right? I think growth continues to be the risk of coming down rather than inflation spiking. But inflation has come down. So if you're on the side of the bull, you're seeing strong earnings along with strong corporate fundamentals, and you're seeing this soft landing take place where you're getting inflation down and economic growth is not being pushed into the negative. On the other side, you're going to hear people say from a bear perspective that, economic growth at some point will contract. And it wouldn't surprise us if we get down to that 2% trend, maybe a little below that. But what you're hearing are people getting concerned that the labor market is starting to weaken. You saw a couple prints in a row where you started seeing labor market start to creep up a little bit. But we're still at 4.1, 4.2% on unemployment. Still really strong labor markets. And we haven't seen economic growth really start to dip yet. It doesn't mean it can't happen. It's something we're keeping an eye on, but you're not seeing it stem through the economy. A lot of this comes down to the consumer remaining really strong. And to me, if I'm going to sit on one side of this, I still am bullish on the market, bullish on the economy. And I highlighted in red here what's really important. That's, and I'll talk about it shortly to show you kind of what I'm talking about, but earnings matter. And earnings matter probably as much as anything out there. And you're seeing corporate earnings. This is on the S&P 500, not only for 2024, but projections for 25 and 26. Year over year, double-digit growth in earnings. That type of growth environment is very supportive for equities and kind of puts a little bit of a floor on where you can expect markets to really go from this point forward. And on the right-hand side, that's a big part of it. You've seen profit margins remain really, really healthy. So when we say corporate fundamentals look good, you can point to kind of the earnings picture. You can point to liquidity or leverage from a debt perspective looks good. Net interest costs look good. A lot of these companies, just like many home buyers refied in 2020, 2021, a lot of these corporations did the same thing. That looks good, but on the right-hand side, profit margins have remained really healthy and at some of their all-time highs. To me, the bulls have the clear case when we're talking about this debate, bull versus bear. Let's go to the different world of animals, doves versus hawks, right? And what we refer to in that world is, doves tend to be individuals who want accommodative monetary policy. They want rates lower because they're more focused on a strong labor market. They want to focus on labor, whereas hawks, on the other end, they are more supportive for rates remaining a little bit more restrictive to keep inflation level, right, or at its target. And this is when we talk about the Fed's dual mandate being full employment, call it between 4% and 5%, right? That'd be kind of full employment for the Fed, and keeping inflation positive, steady, call it their 2% target. Hawks versus dove, they focus on one end of those a little bit more than the other. But I think when you think about it in absolute terms, what the market's pricing in, and this is what I'm showing you, is the end of next year. So the end of 2025, what the market is pricing that the Fed will do, or where they'll be at that point. So for perspective, the range is at the top there at 4.75 to 5%. They just cut 50 basis points, so 4.75 to 5% is their range today on short-term rates. At the end of next year, the market is pricing in somewhere between 2.5 to 3.25, which means between now and the end of next year, the likelihood is that the Fed will have cut 1.5 to a little over 2, probably 2.25%. That's a lot of cuts between now and then. The clear direction is in one way. Rates are going to get cut, and then the question becomes, how quickly do they do so, and what do you prioritize? So to me, I lean a little bit more towards the hawk side of this conversation, meaning I want to be careful about how quickly I'm cutting rates. Sure, if the labor market really picks up from an unemployment perspective, and you start to see a weakening in labor markets, a weakening in the economy, you want to have that ability to cut rates, and we should cut rates. But until you start to really see that deterioration, I think we should prioritize keeping inflation on its current track, because a spike in inflation changes this whole narrative and really will cause a whole lot of pain across the economy. So to me, if I'm in Jay Powell's perspective, I'm going to focus on cutting rates, but slowly, but methodically, and balancing these two things, right? It's okay that if unemployment ticks up from 4 to 4.1 or 4.1 to 4.2. If you start to see it tick up closer to 5, right, into the mid 4s, I think that's naturally cause for cutting quicker. But if we cut too quickly, we do two things. One, naturally, the concern is that inflation could pick up. But two, and I think more importantly, you only have so many arrows in your quiver for stimulating the economy when things go south, and if they go south. So to me, by being patient, you can cut rates in the event that things start to pick up or worsen from an economic perspective. So to me, I'm going to lean more towards the hawk side, be patient with cutting rates, bring them down, right? But I think we have to be careful with just slashing them 50 basis points at a time over the course of the next, year and a half or so. The last debate and this thing has been going on for a long time, but it's fiscal versus monetary policy, and what matters more? What current situation matters more? Is it our more restrictive monetary policy, where you have rates a little bit higher than they've been over the course of the last couple of decades? While the Fed had been restrictive or accommodative for a long time, people know really low rates, they were pumping money into the economy. They've since started to cut that. They've been more restrictive by raising rates above 5% very quickly. You've seen them start to take liquidity out of markets. But on the other end of the coin, you have fiscal policy. And I think this is a conversation that comes in a lot around, political debates of both the debt level, right, spending at the economy level from a U.S. budgetary perspective, This is something that nobody wants to touch, right? Nobody has touched it, but then also comes into other things like Social Security, right? There's a point where Social Security runs out. That needs to be addressed. These fiscal policy decisions have been very expansionary. We are running budget deficits. You can see it here. We are consistently running budget deficits, and our net debt is continuing to accumulate. Is this a bigger issue than running more restrictive monetary policy? And to me, I think the entire conversation should really focus around the fiscal side of the conversation. And look, this could be just who I am as an individual, but one of my key focuses is like at some point we have to address this. There is a level of debt that likely becomes very restrictive for the United States. We have to address that. Social Security is a big crutch for a lot of people here in the US. We have to address that. So how the US addresses its fiscal situation, to me, is the more important side of the coin. The US being a little bit restrictive on interest rates at call it 4.75 and slowly bringing down rates, I'm okay with that, right? I think that's less important than addressing this. This is probably a longer term issue than monetary policy per se, but to me, this should be coming, to the forefront for us to discuss. But this is something we look at in terms of what an increase in debt levels, increase in interest costs, what that has ramifications for in markets, in the economy, for asset returns and fixed income, because one of the biggest asset classes out there is fixed income, and one of the biggest pieces within fixed income are US Treasuries, and what happens within those, if the fiscal situation worsens or doesn't get addressed over the course of time. I would be remiss if I didn't remind you, as Steve did, that there is an election coming up. It is certainly always tense. It's something that is very personal to a lot of people. The challenge with running returns in election years always comes down to they're every 4 years. There just aren't that many data points that we can point to. But one of the things we always remind people is, one, you have to check your emotions at the door. First and foremost, it has to be around your financial plan, what you need your investments to do. That will drive what we need to do looking forward. But I always tell people, no matter how you feel about something, always look at the data as well. And what has seemed to happen over the course of the last little over a century, about a century and a quarter, is when you look at what happens with equities when the incumbent does not run, right? There's only been a few instances that we're looking at, but what we've seen is that markets have tended to do pretty well. There's only been one back in, I believe it was 1920, that it was negative quite a bit. But as we look forward, stats and data kind of prove that you don't know what's going to happen. It doesn't mean that just because of the volatility that things are going to pull back or that you need to be worried. Quite the opposite. Markets tend to perform well during election years, even when the incumbent does not run or decides to not run. That's not a prediction as we look forward, but I think it's something to keep in mind as we look forward. And I always like to give this public service announcement, if you will, of what matters, right? Because emotions tied to things like the election or to geopolitical conflicts, they matter less in the long term rather than corporate earnings and fundamentals underneath the hood. So what you see is the line, the top line that's zigging and zagging, is the price change of the S&P 500, right? Just US large cap stocks. And then underneath the hood, you can look to see what's driving that. The green line refers to earnings growth, and this is over the course of pretty much this year. And that goldish color refers to multiple growth, right? Meaning where people are willing to spend more or less per unit of earnings. You always hear about it, price to earnings ratio, things like that. When things are doing well and people are optimistic, sentiment's very high, that will expand. When people get concerned and they're willing to pay less, they'll pull it back. You see the emotional side of this roller coaster is up and down, and that drives a lot of things in the short term. But over the course of time, it's been shown that earnings growth, and really where earnings grow for those underlying assets, are going to be the key steady driver of whether things do really well or whether things start to pull back. And right now we look at it and we see that earnings continue to be a pretty good picture. You saw on an earlier slide that earnings growth for 25 and 26 right now is projected to be pretty strong. So we are optimistic for markets as we look forward. because I think you have this backdrop. And regardless of what happens from a sentiment perspective or valuation perspective, we look at that as a short-term issue that people just need to weather. And we're not buying stocks for the next 3 months. We're focused on the underlying fundamentals, earnings that are going to ultimately drive returns over the course of time. But I always like to leave it with, portfolio positioning. How are we thinking about things moving forward? One, we've said this for quite some time now. We are still overweight US over international pretty sizably. One, US dollar being strong will favor domestic, but really, if you look on the right-hand side, if you look at that gray line, which starts to really take off after 2020, that's the US relative to China, Japan, Europe, and then just emerging markets in general, where you see US earnings, and it's not a surprise, but US earnings and earnings growth has just been really, really strong. And especially when you compare it to the rest of the world, it is a really favorable backdrop. We are overweight US for that reason. And naturally, we are a little bit biased in general to the US. But if we look at just stock markets in general, the question we'll get is, look, things are expensive. There's a lot of things out there, geopolitical. There's an election coming up. You have the Fed who's starting to finally turn the page, but they've been a little bit more restrictive. You have a housing market that is just stuck. All these little things feel bad. But we're still constructive on equity markets because of the stuff we had just discussed, right? The fundamentals look really, really good. And there's not a whole lot that is screaming at us that we need to be running for the hills. And even so, a lot of times our philosophy is we have to be able to weather that and make sure we're just being diversified and approaching it more in a proactive way over the long term, tied to our financial plan rather than trying to time the market in the short term. A couple of our focuses are still leaning into dividend paying equities. We have tried to take some of those gains within big tech, taking some of those gains and adding a little bit to dividend paying equities. We see as rates come down, it could be a supportive environment where people are looking for yield outside of bonds. Dividend paying equities, similar to how they were talked about back, in 21, where rates were extremely low. We look at that as a place that people may look for some yield. And the semiconductor industry is one within tech, within some of those bigger names like NVIDIA and TSM and those kind of names. We do like that industry. We like that for a couple of years now. Within fixed income, we said it for a little while going back to the beginning of 2023 that we are constructive though in core fixed income. One of your best predictors of future returns in bonds is where you start from a yield perspective. And what happened in 22 was painful. But at the beginning of 23, you saw your yields, even though they've come down recently, still 4.5. They were 5+% not that long ago. Those returns are much more attractive for portfolios and for diversified investors than they were looking back to 22, really before 22 and 21, when they were so low that it was hard to generate a whole lot of return within fixed income. We can find that return within core fixed income without taking a whole lot of risk within our portfolios. All right, so I said a lot, Steve. I'll turn it over to you just for some Q&A. Be curious what we're hearing, what we're seeing from others, and happy to address any questions.
Yeah, thanks, Mike. So just a reminder, folks, you can ask a question via the chat function at the bottom of your Zoom screen. Mike, we did get one actually a couple, interestingly, around the Chinese government stimulus that was announced. And the question is, Mike, can you give us perspective on whether it's time to reconsider allocating to China?
Great question. So for those of you who don't know, was it last week or the week before? Either way, within the last week or two, the Chinese government really started to announce and started to enact some both fiscal and monetary stimulus for their market. For those of you who don't know, they've been in quite the rut. They have what will be a population issue. They've had a massive real estate issue. And what that ties back to is just a consumer issue. When you have a real estate market that has caused so much destruction, what you're seeing is the Chinese government tried to become more accommodative, right? Whether it be from stimulating the economy, to cutting rates, to trying to prop up or help maybe the IPO market or business owners, all these little things try to help the real estate sector is one of the biggest issues, try to help that issue. So there's been a whole lot of stimulus being thrown out there. And what you've seen is both emerging markets, and specifically China markets, kind of do this really massive zigging and zagging, where you've seen a big pop and then you saw a pullback, big pop, pullback. A lot of it is around how realistic is this stimulus? What's it going to do? I said it, I think, on Friday when we were interviewed on this. It feels a lot like a Hail Mary. I put it into football terms as a Hail Mary for what the Chinese government's trying to do. I don't want to say it's too little too late, but it is hard to just throw this all out there at once and get meaningful change from an economic and consumer perspective and foreign investment perspective immediately. So, kind of going back to your original question, Steve, or the question from the individual is, we do think it's still too early. Those who have some allocation, we have a small amount to international emerging, right? But it's not all that meaningful. We do not think it's time to lean heavily into it in any way. I think having a small strategic allocation right now still makes sense. And look, if things change underneath the hood, where you're seeing consumer spending and debt levels change in China, and you're seeing a more accommodative stance to foreign investment, then it maybe is time to reconsider. But for now, we have not hit that point. It still feels a little too desperate, and there's still a little, I would probably call it a little less risky areas to invest in the equity market.
Understood. Thank you for that. We have a few coming in here. Next one, what is your view on small caps? I know lower rates are good for small companies, but it's concerning to invest, or can be concerning to invest in the Russell 2000, given that many of those companies are not profitable yet.
Yeah, great question. So small cap, I think starting from first and foremost, when you talk about the macro landscape, 100% right. The reason why lower rates are better for small cap companies is a lot of times their debt is floating rate compared to larger, more mature businesses. If you looked at the S&P as an example, I believe like 6% of the outstanding debt is floating rate, whereas that number is substantially higher for small cap. So lower rates and expectations for lower rates will be accommodative for small cap. But I think, and I don't have the graphic here on the sheet, and I wish I did, but the biggest thing for small cap has been the earnings landscape underneath the hood. When you saw earnings growth for the US go so, at least relatively, so much quicker and recover so much quicker than the rest of the world, a lot of it was concentrated in these big names, especially in US large cap. Small cap has gone through this earnings recession over the course of the last year, where it makes sense why there's been this lag, is you have not seen earnings rebound in the same way. We are starting to see that change a little bit, but I think investors need to be patient. We still like small cap. We like large cap just more. And we think small cap has a chance to really rebound. And you want to have an allocation for when you start to see that, because it'll really come from this rebound in earnings reports that you're going to see from small cap companies. For such a long time, you look at the numbers quarter over quarter over quarter, US large cap growth continued to drive it. But what we're seeing are projections starting to change for not only the other 490 names in the S&P 500, but small cap starting to add some projected growth to US equity markets. One of the things that's a really important comment that was made, it's a great point, is that it's over 30%, and it could be approaching 40% of the Russell 2000 is unprofitable. So you're owning a lot of unprofitable businesses, and it doesn't mean that they're all bad, but it means that there's not a whole lot of safety there and a whole lot of backstop. So one of the things that we are changing, and we tend to prefer in our portfolios that we're going to be leaning into, is preferring, when we go more passive, is leaning towards the S&P 600, which are the bigger names within small cap, more profitable names, the ones who actually have profit, rather than the vast majority of the Russell 2000 or the big allocation within the Russell 2000 that doesn't. It's also a preference why we typically prefer to be more active in small cap, because of what we call flaws within the passive benchmarks. But when we look at small cap, it's been a while, it's been hard to stay patient, but we do think it's still an okay allocation within an equity portfolio to have, because we're starting to see that rebound on the earnings side, which we've said it multiple times. The earnings landscape will drive this. It has been painful for small cap investors to see the earnings side of things, but you're starting to see the projections start to pick up, and lower rates will only help that.
Fantastic. Thanks, Mike. Another question here. I'm going to ask you to put on your or look into your crystal ball here.
Hmm.
I like how you navigated the political conversation earlier. This one is related. So tax implications of election result. I'm guessing the question is around, do you have a thought on, no matter which side wins, or if you have a thought on which side wins, from a tax standpoint, what the impact would be?
Yeah, I think you have to go underneath the hood of what policies are stated, and naturally, so much of this will be driven by what happens with Congress as well, because we all know split government, a lot more checks and balances, a lot harder to really get what you want through. I think naturally, if Kamala Harris wins, I think projections are, and what's been stated are, an increase in the corporate tax rate. Right, so up front, you will see a corporate tax rate hike most likely, and probably the high end of the tax structure will probably move up. With the Trump side of things, I think you're probably looking at more of the status quo. But so much of this is fluid, right? You have to see what's going on at Congress level. But to me, I think tax rates, corporate tax rates, if they're going to go anywhere, they're probably moving up a little bit. And you see markets react to this, right? In some ways, when you start to see this pricing in of one side winning over the other, you start to see parts of the market perform well versus the other. But we have seen projections of even what happens if a corporate rate does move up, and what it would do at the surface would have a slightly negative impact on S&P 500 prices, right? Naturally, because your bottom line earnings would then get hit a little bit harder, but nothing overly meaningful, right? We're talking 5-7%, and so much of this is just fluid of here's one projection. So to me, I think the short answer is, they're probably, you're looking at where they're at today versus moving up incrementally. But I think even Harris versus Biden, their stances on the tax side, it has eased from the levels that were originally thrown out there when Biden was running.
Understood. And you also mentioned the deficit in spending earlier, so that would need to get addressed at some point as well. A couple more here. So I'm going to try to make this next question a little more general. The question was around specific high yield or high dividend ETFs and different offerings within the ETF world when it comes to high dividends. To make this more general, how do you and team approach selection of ETFs when it comes to dividends?
Yeah, so I think you can think about it in a couple different ways. You can have a more passive approach on the ETF side, or you can go more active. We've elected to primarily go more passive on the dividend side, and really what we focus on are a couple different things. One, we want to see a broadly diversified portfolio underneath the hood. So we're willing to give up a little bit of yield on the dividend side to not over concentrate into things like energy, as an example, or just only own utilities or some industrial parts of the market where they're classic dividend payers, very mature businesses, but growth metrics are pretty lackadaisical. So what we like is a more passive approach if we're going to do it with reasonable dividend payments, but we want to see within there a screening or a process to account for growth, because we want both dividend growth and we want earnings growth of those businesses, because it gives you a broader array of dividend paying companies. We just don't want to go buy somebody because they pay a 5% dividend, but they haven't grown as a business in no time, and they're paying that kind of dividend because they have no growth prospects. We're trying to identify and have a passive allocation that gives us a little bit of that balance of, we want that dividend income, we want that dividend allocation in most of those sectors, right? Utilities and staples, the classic energy a little bit. But what you'll see are there are some names within there, if you include some of these growth components, that you can get allocations to decent dividend payers who are also growing, and they're not just these big mature businesses that have no growth prospects. You're getting a more broad array of dividend allocation. So that's been our approach. We think that's a way to balance that, because going one direction of just focusing on pure yield, I think you pigeonhole yourself and you buy a very specific business, whereas adding kind of this growth screen as well as the income, the dividend component, gives you kind of this better diversified approach to the income yield within the equity side.
Great, thanks, Mike. Another one just came in from an economic and market standpoint. Is there any additional fallout from tensions in the Middle East worsening?
Yeah. Yeah. I always tell people one of the things, things can always get worse. They can always get better, right? But we're just working with what we know today. Markets will price in very quickly what they think of what's happening now. So I think markets have priced in what they see now. I think naturally one thing that is probably some of the bigger fallout is energy prices. Energy prices, given Iran's involvement in the Middle East now, could potentially escalate oil prices going into the winter now, where maybe you start to see commodities start to pick up a little bit. It's probably mostly on the commodity side, less about the equity side. But on the commodity side, you have to keep an eye on oil, energy prices. You could see that stem through to maybe headline inflation, which that's always volatile. We're more focused on the core inflation side, but I think markets will tell you what they think of the economic and market ramifications of what's happening. They've been relatively smooth from that perspective. You're probably seeing a little bit more volatility on the commodity, especially energy side, which is where I think most of this is isolated right now.
Understood. Next one here. What about a small and mid cap quality screen for small cap investing? So how do we, you mentioned a few things earlier, Mike, around how we look at small cap and your thoughts around that. If you can expand it to mid cap and talk specifically how you screen and your team screens when it comes to small cap investing.
Yeah, and I think that is very much the way we want to look at it too, right? Because if you buy the Russell 2 only, right, which we've owned in the past in terms of just trying to get a passive exposure to small cap while we adjust what we're looking to do on that side, our preference has always been more of the active approach. And the reason is because you can get higher quality names within small and mid cap. When you have that active overlay, you have much more of a fundamental view of what's happening from a profitability perspective, a growth perspective, the competitive positioning perspective. Whereas the Russell 2, because it's 2,000 names and a lot of them are unprofitable, you get a lot of what you'd call kind of junk per se. But I think there's a couple of things you can do. One, there are plenty of investments that have a quality screen, and what that quality screen likely will do as part of that position will screen out over-levered companies, unprofitable companies, revenue growth metrics, a lot of the fundamentals that kind of give that quality name underneath the hood. I think you can look for an ETF like that. I think you can also look for using the S&P 600 instead of the Russell 2000. The S&P 600 is a higher quality kind of small cap, mid cap world where I think you'll get better quality than the Russell 2. Or to us, if we're going to look more active in that small cap space, we're going to make sure that whoever we're investing with from a manager standpoint has a very good screening and qualitative process to evaluate the quality of a business, the quality of their finances and management company, and all those little things that matter when selecting companies, especially in small cap. So I think you can look at it a couple of different ways. One, rethink what index you use. Two, you can go buy a passive investment that has more quality screens to them. There are plenty out there. And then three, you can go more active where this will likely be a high priority across the board, regardless of who you buy on the active side.
That's fantastic, Mike. So I don't see any additional questions as of now. So any last comments on your end?
No, I think from me, that's it. If anybody has any
Great.
questions, we're always here, as always. Reach out to your advisor. They'll connect with myself, my team. We're always here to answer any questions, give our perspective, and walk through anything that would be helpful.
Sounds great. Well, thanks again to everyone for joining us today. If you joined late, the webinar recording will go out in about a week's time. So this webinar was recorded, and if you missed anything, you can review it on the recording. But once again, I want to say thank you to everyone for tuning in. Thank you for your trust, and hope everyone has a great week. Take care.